parent company Eternal is testing a new hardware pilot called Zomato Now. The initiative prompts an essential question for the industry. Is deploying physical hardware a strategic evolution, or is it a sign that quick commerce delivery is reaching a hard ceiling? The pilot involves installing fresh food pods, smart vending machines, directly inside corporate offices. This represents a shift in the company's physical footprint. They are adding a capital-heavy hardware model to a business that has historically relied on an asset-light network of riders and software. These pods allow employees to select pre-stocked meals and collect them immediately. By removing the need for food preparation and rider routing, the system aims to eliminate the customer's wait time entirely. This pilot introduces physical inventory management into an operational model that Zomato originally designed to scale through decentralized, software-led logistics. At this stage, the deployment is highly targeted. These machines are only operating within select corporate offices in Gurugram. To maintain stock, Zomato partners with specific restaurant brands who prepare meals in bulk to be loaded into the machines on a daily schedule. Management has maintained a data vacuum around the experiment. Eternal has not disclosed the number of active machines, the corporate partners involved, or the total capital expenditure allocated to the hardware. Testing in a high-density tech park provides a controlled environment. However, this setting avoids the varied regulations and logistical friction that would occur during a broader nationwide rollout. Without official performance data, the pilot must be evaluated through the lens of micro-retail unit economics. The logic behind the pods stems from the logistical friction found in business parks. Security checkpoints and elevator wait times can add significant delays to every delivery. On low-ticket lunch orders, the cost of rider idle time often exceeds the commission the platform earns on the transaction. Corporate hubs provide a captive audience. Thousands of potential customers are concentrated within a single building, creating a high-density demand pool. This demand is also highly predictable, with the vast majority of orders occurring during the 12 p.m. to 2 p.m. lunch rush. For restaurant partners, centralized bulk drops to a pod are more efficient than fulfilling dozens of individual deliveries. On paper, a refrigerated pod in the lobby solves the time bottleneck and removes the last-mile delivery fee for the platform. This transition introduces a different cost structure. Zomato is moving from a model driven by variable operating expenses toward a model that requires significant upfront capital for physical hardware. Physical machinery brings secondary costs, including rent for lobby space, routine maintenance, and physical restocking. The company has attempted rapid delivery before. In May 2025, Eternal ended its 15-minute delivery experiment. That initiative was consolidated into Blinkit's Bistro, which uses dedicated cloud kitchens to target 10-minute delivery times. If 15-minute delivery struggled with unit economics, it is unclear how the added costs of maintaining and stocking refrigerated pods will produce a different outcome. The model also risks internal market cannibalization. Zomato now competes for the same lunch hour volume already serviced by Blinkit's Bistro cloud kitchens. Deploying a capital-intensive vertical alongside an existing optimized ecosystem creates conflicting pressures on the overall profit margin. The primary operational risk for these pods is the inventory management of ready-to-eat meals. Unlike packaged snacks, the shelf life for these meals is measured in hours. Even minor miscalculations in daily demand within a specific building result in food waste. Because food margins are tight, unsold inventory can quickly turn a profitable machine into a net loss for the day. This financial summary from ICICI Securities shows Zomato's current profitability trajectory, with steady improvements in both net profit and EBITDA margins. The report highlights that Blinkit achieved adjusted EBITDA breakeven in Q3 of fiscal year 2026. Here, management emphasizes a focus on achieving a return on capital employed of approximately 40%. The report already projects an increase in capital expenditure per store. Buying and maintaining thousands of vending machines puts further pressure on that 40% ROCE target. Public equity markets often react poorly to capital experiments that threaten to dilute a company's return on capital. While the pods may be viable in a few Gurugram offices, scaling this model presents a risk to Eternal's balance sheet and profitability metrics. As a research and development project, the pilot serves a different purpose than direct profit generation. For a company of Eternal size, the capital required to test a few dozen pods is relatively small. The strategic value lies in localized consumption data. These pods act as physical sensors, capturing building-level demand. This data refines forecasting for hyperpure supply chain, identifying which ingredients business districts need. It also informs blanket expansions, pinpointing high-demand areas beforehand. Zomato Now acts as a distributed intelligence tool, collecting data that benefits the entire ecosystem. Ultimately, Zomato Now represents a new direction for the brand. This project is a tactical hedge while the company tests the viability of physical infrastructure. The success of the pilot depends on two undisclosed metrics: the unit economics of the hardware and the daily spoilage rates. The experiment suggests that routing software is increasingly constrained by the physical capacity of urban roads, regardless of algorithmic complexity. The industry may be approaching the limit of what can be achieved through a gig economy delivery workforce in dense cities. As companies hit these physical speed limits, physical hardware could become the primary path for growth in urban food delivery.